Time for our ETF Spotlight. Mike Santoli here with us at Post 9. Taking a look at Treasury ETFs, I bet for a good reason.
Another way to look at this flattening yield curve. You know, I mean, obviously we talk about it as terms of gaps in yields at different maturities, which is what it is, but it also represents rallies in some maturities of treasuries more than others. And so if you look at, for example, these three different slices of ETFs, there you have in the orange long-term bonds. This is over a 1-month period. That's the TLT, 20 years and beyond. That's the most duration you get. You see a huge rally for bonds, for treasuries, 4% in the last year or so. SHV is the very short term. That's kind of from like 1 month out to 3 years. Basically steady. Those prices are always pretty steady. And then in the middle there is the iShares 3 to 7 year treasury, IEI, and that's up a fair bit. And I think one thing that's getting lost, we're talking about, you know, the 5-year yield being below the 2-year. It's really a huge rally in 5-year notes that is driving this whole story. So the yields in 5-year treasuries are down so much in the last, let's say, less than a month, from 303 down to 281, way more than other maturities are down. So basically, there's been either a positioning shock in there. There was a lot of people short the middle of the curve, but also if the message, if there is a message, is that we can see the end of the Fed's tightening campaign coming into view, that 5-year area is where you're probably going to have perceived value, right? Because yeah, we're going to do another hike in December, and there's maybe 1 or 2 more you can fit in under the 2-year yield where we are right now at about 280. But it's that 5-year that seems like, okay, now we're probably, who knows, maybe we go down from there if we hit a recession before the 5. So that, to me, is the dynamic driving this flattening.
Wow, that's a really good explanation of
and by the way,
yeah.
the 2 to 5s first inverted in December of '05. So way before the previous recession.
Right.